Have you ever felt like the market is just speaking a completely different language? Well, today we're going to decode it. We're going to learn how to actually read the story that financial charts are trying to tell us, all through the art and science of technical analysis. Let's dive in.
You know that feeling, right? You pull up a price chart and all you see is this chaotic, unpredictable jumble of lines going up and down. It's so easy to feel like the market's movements are totally random, kind of like static on an old TV screen.
But what if it's not just noise? What if it's actually a language? A really complex story that's being driven by things like human psychology, supply, and demand. You see, the whole idea behind technical analysis is that you can absolutely learn to read this story.
So here's our game plan for how we're going to get fluent in the market's story. First, we'll get the basics of the language down. Then, we're going to figure out which direction the market is heading. That's the trend. After that, we'll look at how to measure the power behind those moves. Then we'll map out the market's overall structure. And finally, we'll put it all together to see the complete picture.
Okay, first up, let's decode the basic language of the market. We've got to understand the core philosophy that holds up everything else we're about to talk about. So, what is technical analysis at its heart? Well, it's really just the study of two things, price and volume. The key idea here, and it's a powerful one, is that everything, all the news, the earnings reports, people's emotions, it's all already baked into the price on the chart. So we're not trying to guess, we're interpreting the collective behavior that's right in front of us. And this whole approach really rests on three core beliefs. First, the market isn't random, it moves in trends. Second, human nature doesn't really change, so patterns that are driven by fear and greed tend to pop up again and again. You know, things like a head and shoulders pattern, that's just a picture of crowd psychology playing out. And third, at the end of the day, every price move is just a result of supply and demand. That's it. All right, with that foundation in place, let's move on to our first big building block, figuring out the market's direction. It's all about finding the flow.
I absolutely love this metaphor. Trend indicators aren't going to tell you your final destination, but they are your compass. They show you which way the current is flowing, which, as you can imagine, is crucial if you don't want to be constantly fighting against it.
Now, a super simple way to use this compass is with something called a moving average. It just smooths out all the jerky price movements to show you the underlying direction. So, if the price is staying above its average, hey, the trend is bullish. If it's staying below, the trend is bearish. It sounds simple, and it is, but it's incredibly effective.
And of course, things can get a lot more advanced. You've got tools like the EMA ribbon, which gives you a great visual for the trend strength. Then there's the MACD, which helps you spot when that trend might be shifting gears. And with multi-timeframe analysis, you can zoom out and make sure the trend you're seeing on a daily chart isn't about to run into a brick wall on the weekly chart.
Okay, so now we know the direction, but how much power is really behind that move? Is it a gentle breeze or a hurricane? That's where we need to measure the market's force, using momentum and volume.
And this just explains it perfectly. Think of momentum as the market speedometer. It tells you how fast price is moving in a certain direction. But volume is its voice. It tells you how many people are shouting, how much participation is behind a move. It helps you know if it's the real deal or just a bit of noise.
The RSI is probably one of the most famous momentum tools out there. It measures the speed of price changes. Now, you'll hear people say a value over 70 is overbought and below 30 is oversold. But you got to be careful. That doesn't always mean a reversal is coming. In a really strong, healthy trend, the RSI can stay overbought for a long time.
Now, to hear the market's voice, we can use an amazing tool like the volume profile. Instead of just showing you volume over time, it flips it on its side and shows you how much volume traded at specific price levels. And this is huge because it pinpoints exactly where the big institutions were most active, creating these really powerful zones of support and resistance.
All right, next up, we need to get a handle on the playing field itself, the market structure. And this means mapping out its volatility and its key price levels.
It's so easy to be afraid of volatility, but you shouldn't be. It's literally the breath of the market. It's what creates opportunities. The trick isn't to try and avoid it, but to understand its rhythm. To know when the market is taking a deep breath in, getting ready for a big move, and when it's just exhaling and chilling out. Bollinger Bands are a fantastic way to see this breathing in action. When those bands squeeze together and get really narrow, that's the market getting quiet, you know? Volatility is low, but that quiet, that's often the calm before the storm.
When the bands start to expand and widen out, volatility is picking up, and that's your signal that a new trend might be kicking off.
And look, in today's markets, support and resistance aren't just static lines you draw on a chart anymore. They're dynamic, they're alive. Indicators like an EMA ribbon or Fibonacci levels create this kind of living map of the market's key zones, and they adapt in real time as that battle between buyers and sellers is constantly changing.
Now for the most important part, putting it all together. We need to combine trend, force, and structure. This is the synthesis, the final step where we really become fluent in the market's language.
And this is where composite indicators are just incredible. Instead of just looking at one thing at a time, they blend different concepts. The MACD we mentioned earlier, perfect example. It combines trend and momentum. The Ichimoku cloud takes it even further, wrapping up trend, support, resistance, and momentum into one single coherent visual. The goal isn't just to add more clutter to a chart, it's to harmonize these different signals into a much clearer message.
This, right here, is the future of analysis. It's about multi-factor models. You have these powerful algorithms that can take in all this data, trend, momentum, volume, and create a single simple index that just tells you what's going on. It's about taking all that complexity and turning it into real clarity. But we have to be crystal clear about something. None of this, not a single indicator, not a single algorithm, is a crystal ball. It does not predict the future with 100% certainty.
Technical analysis is the art of managing probability. It's about using these incredible tools to figure out when the odds are stacked in your favor and then having the discipline to act on it. It's a skill you develop, not some kind of magic trick.
And all of this leads us to one final, really big question. As we continue to blend our own human skill and intuition with the raw analytical power of machine intelligence, the very language of the market itself is evolving. So what story do you think it's going to tell next?